Hello and thanks for tuning into the trade setup right here on BQ Prime. I'm Neeraj Shah. A quick update of the FOMC outcome before I get in our favorite guest, Jeffrey Dennis. So the Fed increased interest rates by 75 basis points for the third time in a row. Our forecast is for a further 1.25 percentage points of tightening before the year end, which would mean that they'll do 175, right? And I mean, if they wanted to do a one, they would have probably done it this time around. They've not, which means they'll probably do another 75 and then maybe the remainder later on in December. Fed officials cut the growth projections. They have raised the unemployment outlook. And more importantly, Jerome Powell repeatedly spoke of the painful slowdown that is needed to curb price pressures. What does Jeffrey Dennis make of all of this? He joins in, as we usually request him to do, after such important meetings, to give us his sense of what he made of the commentary and the market behavior, and of course the India implication as well. Jeffrey, great having you. Good evening. What did you make of the action and Jerome Powell's comments?
Well, for the first time, I think it looks a little bit like overkill here from the Fed now. I'm surprised they were as aggressive as they were. I think the market was beginning to believe that we'd get 50 next meeting and maybe another 50 after that, and then at around the 4% level, 4.25, we would stop. Well, the Fed has now basically told us their plan on current data anyway is, as you say, to raise rates by another 75 next time. So that's a big surprise to me. The other thing which I think is very surprising is how Chairman Powell continues to focus on 2% inflation. Now, trust me, 2% inflation is a long way away. They're talking about 2025. And if he wants to talk about 2% inflation, it does imply that we're going to be looking at relatively high interest rates for a sustained period of time. My own view has been for some time is that once you get rates to 4.25, maybe 4.5, and there's visibility, I use this word all the time, of inflation falling to around 4% by the end of next year, it'll be a good sign that monetary policy is beginning to do its job, and the Fed can eventually take its foot off the accelerator. But this was a very, very hawkish, not so much the move itself, the 75 basis points, but the commentary that went with it and the forecast that went with it. And I'm not surprised the equity market behaved the way it did.
The last two times that we've spoken, Jeffrey, you mentioned about how well the bond markets behaved, and the yields give an indication that the pain may not be as prolonged, if you will. I'm not quite quoting you verbatim, but that's what I made of, at least I had made of your comments then. Did the bond market behavior this time around post policy, particularly the yields, make you change your thesis a little bit, or are you still on song?
No, my thesis hasn't really changed. I think what I've been surprised about, to be fair, is that bond yields have risen as much as they've done in the last few weeks running up to this particular meeting. My view had been for a while that the peak that we reached in, I think, June of 3.5% on the 10-year was probably the peak. Now, we took that out. We haven't taken it out very much, but we did take it out. Now, what's interesting about today is that bonds actually, if anything, rallied a little bit. Of course, the short end yields went up a long way to indicate the greater distance the Fed feels it's got to go. So the yield curve has become more and more inverted. What does that mean? That means I think the market is thinking the Fed will get on top of inflation eventually. And that's why bond yields are rallying. Bond yields, 10-year bond yields are rallying. 10-year yields are rallying also because there's a sense that we now have a much greater risk of recession, which I completely agree with. And the inverted yield curve is telling you the Fed still thinks it's got a lot to do. So I view one of the positive things out of today, if you can find any positives, is how relatively well the bond market has behaved. And I think that's telling you that, as I say, the fight against inflation is slowly being won. I'm just surprised here that the Fed has opened up the possibility to quite such aggressive moves again in the next two meetings.
Yeah, but Jeffrey, I'm surprised you're talking about the possibility of a recession. I thought the Fed probably wants to engineer the recession to tame inflation. Inflation can topple governments. I think that's what the Fed seems to be wanting to do, no?
I'm not sure about that because,
Okay.
for sure, I mean, this is a very important point. The volatile stuff on inflation, the food and energy, has stopped being a positive influence on inflation, pushing inflation up. It's now at the margin pulling inflation lower. So basically, the core numbers are now more troublesome than the headline numbers. And that's because you're seeing oil prices come down, they're stabilizing now, but gasoline prices have come down a long way in the US. Food prices are rolling over. A lot of commodity prices are rolling over. So the worry, of course, that the Fed has got, and I accept that, is that wage inflation's pretty strong now. And obviously the core element of inflation, indicating a spreading of inflation through the economy, has picked up. And I don't think you can deny that. But at the end of the day, the inflation numbers are beginning to get under control, in my view. The core of 0.6 last month, which freaked everybody out. We've had a number of 0.6, 0.7s already this year. And of course, the headline number was minus 0.1, and then it was plus 0.1 the following month, is under control. So I think the risk here is that he's going to go into overkill, and there is a risk of recession, which I didn't see before from what I thought would be the Fed's profile of interest rate increases. And I don't think you can say he wants to have a recession. He wants to get inflation under control. What I fear is that it is starting to roll over, and probably core will roll over before too long. And the danger is he will have over-tightened monetary policy with a lag, and then we will end up with a recession.
Yeah. Jeffrey, just one quick final question. We were talking to Sean Darby last week, and he said that the markets may be worried that because we don't know the impact that an over tightening or an over cautious or a hawkish Fed could have on markets, and that might worry the markets more than anything else. What's your sense on EMs in such a scenario? Do you reckon that the overkill could actually, the impact will only be known down the road, and therefore the markets will be worried currently?
Yeah, I think that's right. Although I think it's a bit more straightforward than that. I think the markets don't want overkill because markets don't like higher interest rates. The markets don't want overkill because they don't want to see an increased risk of recession. And I think now, you see, my point has always been, if you could get interest rates up to the 4% level, 4.25%, maybe 4.5%. I mean, of course, we're going to get there really quickly now. We're going to be there basically by the end of the year. And you'll be able to look ahead and see that inflation is going to be 4% by the end of next year, which I think it will be. So interest rates will be at the point where they're about right. And if we go beyond that and do some sort of overkill, the markets won't like it because it will increase the risk of recession. So I think it's a bit more straightforward than that. And by the way, we should be adding one other point, which is that, of course, the dollar has gone up a lot, went up a lot today on Wednesday. And that, of course, is just making things a little harder for emerging markets at the margin, or not all emerging markets, a lot of emerging markets. So the dollar is not helping either. So this is the change of view I've got here today is I think you've now got a greater risk the Fed is going to push this economy into recession. We're going to get overkill. And I think he's been too aggressive here now. Who knows, of course? It's only a forecast. They may not do that. They may find some data down the road that means they don't have to raise as aggressively as they're talking about. But it looks to me like we're now running the risk of overkill and recession, where a slightly calmer response to that recent inflation data would have increased the possibility of a soft landing.
Let's see. The festive season in India ushers in good news. Jeffrey, maybe post Diwali, we might see a more tame Fed, if at all. But thank you so much for joining us today and giving us your sense. Much appreciated.
Thank you.
All right, that's the view from Jeffrey Dennis. He's written a lovely piece for us, by the way, last month on the impact on what's the outlook on EMs as well. You might want to read that as well. But let's stick to today. So the world markets are in a bit of a tizzy. The SGX Nifty should come up on your screen next, by the way, very quickly, just before we get to the trade setup and try and summarize a few stocks that may matter today, really. The SGX Nifty indicates a start which is about 1% lower. Not too bad, you would have to admit. Let's wait and watch if this worsens during the course of the day, especially once Europe opens. So you have to bear that possibility. So what's the trade setup for the day looking like? My trade setup is looking a lot more hawkish than what the markets are indicating, but the heightened rate projections and the stronger dollar are going to hit EMs, including India. I think the dip, there is this whole theory about how aggressively dips should be bought into. My conversation with experts over the last 48 hours, I met the JP Morgan conference, met a bunch of investors as well, not just the JP Morgan guys. And it seemed to be that the belief seemed to be that the dip in which you can aggressively buy maybe some time away. This will not be the dip to aggressively buy. So you have to fasten your seatbelt, so to say. India VIX may break out of its 1 month range of 18 to 20 today. Remember, it's been hovering around this 1 month range of 18 to 20, currently at 19.2 and 19.3. You might see a bit of uptick out there, and that might add to the pain. And high beta names like real estate and metals continue to stay out of favor. Even yesterday's session, viewers, we've been talking about this. Remember, in yesterday's session as well, metals and real estate were the top two losers. What was gaining? FMCG, natural market behavior or tendency. Move towards defensives, stay out of volatility until the trend becomes clearer. I doubt in anybody's mind that the trend is clear right now. Let nobody fool you, really. So in light of this, what are the stocks to be monitored in the session today? The flows aren't a concern as yet over the last 24 or 48 or 72 hours. To be honest, I'm not bringing in the flows picture right now. Let me quickly move to stocks. So oil has held on to losses, and that's actually a positive for India at the margin. But oil has come off, as a result of which, though, you would argue that maybe the outlook for companies like ONGC, Oil India, HPCL, even Reliance might be a bit of an issue. So watch out for the oil upstream companies in particular, even downstream, but mainly upstream, ONGC, Oil India, as oil continues to hold on to its losses. So that's part one. By the way, Morgan Stanley's come out with this very interesting note on energy. They've reduced energy as a whole from overweight to equal weight. They've recommended their global clients to take profits off, or the ASEAN clients to take profits off the table. The view is formed given the clear downside risks to global growth, as well as their recent reduction in their house oil price view. They've brought down their crude price views. They've removed Reliance from their focus list. So they've done a bunch of things on the Asia Pac portfolio. From an Indian perspective, Reliance was in their focus list. They've removed Reliance. So clearly a bunch of people are taking money off the table when it comes to energy. Speaking of Reliance, Reliance Industries, Adani Enterprises, and Tata Power, for different reasons than energy, are also in focus today because the government has approved a 19,500 crore PLI scheme on National Program on High Efficiency Solar PV Modules. The government aims to attract about 94,000 crore rupees investment in the sector. It's great for India if this sector succeeds. Let's see if it's indeed attracting money from the three houses which are really doing the bulk of the capex commentary and the capex action as things stand. A sector to watch will also be IT, because Accenture comes out with numbers today, later in the day. The belief, as per Bloomberg Intelligence, is that the new bookings could see a sharper slowdown than expected. And I think commentary around new bookings will be important from Accenture's side. Piper Sandler is saying that the company may still set an initial FY23 revenue growth forecast guidance in the range of 7 to 10% versus the consensus of 8.1%. Now, it'll be interesting to see what happens to new bookings. It'll be interesting to see what does the company say in terms of guidance. I think both of those factors may have an impact on IT stocks tomorrow. So if you have large IT trades, be mindful that there could be some impact on Accenture's guidance, more importantly, in tomorrow's session. SpiceJet, DGCA has extended the 50% limit on SpiceJet's number of flight departures until October 29. I thought this news came out during market hours yesterday, but I saw it in a list for post-market announcements. So just getting it here. Please excuse me if this is an announcement that came in during market hours yesterday. Some promoter action seen in Mangalam Cement, wherein promoter Pilani Investment and Industries bought about 4 lakh shares and Vidula Consultancy bought about 1 lakh shares. On Adani Enterprises, we continue to see the promoter activity there. Spitz Trade and Investment bought additional 3 lakh shares on September 19th as well. By the way, even on Adani Green, they bought some shares. Standard disclaimer, of course, Adani Group or the Adani Media Enterprise, Adani Media Networks owns 48% stake in Quintillion Business Media, which is the owner of BQ Prime, and Man Infra Construction, wherein the promoter Parag Kesha bought additional 1.84 lakh shares between September 19th and 20th. So maybe that is something you watch out for as well. Very quickly, am I missing something? Just trying to see that. No, I'm not. I don't think so. Let me just try and open up a couple of other points. Yeah, I think there's some announcements around the Navi Mumbai airport being completed by July 2024. Do watch out for that. On KPIT, which was up about 4% yesterday, there's a Goldman Sachs note, and they maintain the target of 900. So, well, watch out. IT is weak, but this one is interesting. Fortis Healthcare, because the Supreme Court may pronounce the verdict today in the open offer case, and that will be really, really important. So that is something to be watched out for as well, viewers. Yeah, those are a few things. Just bear with me for a minute. I'll just try and see if there's something else in our BQ handles which is worth a mention. No, not really. Yeah, stocks like Ambuja, Delta Corp, RBL, and Escorts continue to be in the FNO ban. Yeah, so that is something. India Cement is out of the FNO ban. So yeah, that's probably the other interesting one. Thanks so much for tuning in today, viewers. Watch out, from amongst other things, we'll do a really good conversation on cement today at 10 a.m. with Rakesh Arora. Cement has been the buzzword, right? We'll speak to Rakesh Arora on that. And for all you pharma fans, pharma has been in the highlight, but two people who look at pharmaceuticals very closely, Sajal Kapoor, Aditya Khemka. We do a Twitter spaces with both of them today on B2B versus B2C, branded generics versus unbranded ones, and which ones can really make money over the slightly longer term cycle for investors. These two probably track pharma as closely as any that I've known. It'll be interesting to hear their views on this. It could be a long spaces session. So if you're tuning in, come in with that perspective. Thanks so much for tuning in today. And by the way, for all of you who tuned in slightly late, we had a very interesting 10-minute conversation with Jeffrey Dennis at the start of this trade setup. You might just want to go in and try and hear his view on the Fed move and its implications thereof. Thanks so much for tuning in today.